In part 2 of the presentation on risk and return, we consider portfolio analysis. And as you know, a portfolio is a case where your investment is divided up into a variety of assets. So we're going to begin with an example. Let's say we have 3 investments to consider, A, B, and C. We already have used either historical data or, in this case, probability distribution to estimate how much you can expect to earn on each of the investments, as well as the risks associated with each investment. So we have them shown here, the returns and the risks. And here's the deal. You have $100,000 to invest. Now, you've decided that half of the money will go into stock A with an expected return of 23%. 30% of the money, of $30,000, will go into stock B, and the remaining amount will go into stock C. So these are the proportional investments. So now, to calculate the expected return on this portfolio, we are simply going to take the weighted average of the returns. So that for this 3-asset portfolio, we're going to take the weighted average of the returns of each of the assets A, B, and C. If I go back here, for stock A, whose expected return is 23%, we're going to multiply it by 0.5 and add that to the product of 13% for B and this 30% weight, and add that to this 10% return for C multiplied by 20% weight. So that's exactly what we have here. You weight each of the returns by the proportional amounts. And final answer, 17.4% is on average how much we can expect to earn on this portfolio. It's as simple as that, really. Now though, how about portfolio risk? Well, for starters, there are 2 measures of portfolio risk, either the variance of the portfolio or standard deviation of the portfolio. The 2 are really our alternative measures of absolute portfolio risk measures. But before we show the calculation, it's important to understand the basis for portfolio risk estimation. First, we know that the risk of a portfolio will be affected by the individual riskiness of each of the securities within that portfolio. Secondly, it would also be affected by the proportional investments you make in each security. And finally, it would be affected definitely by the degree of diversification among the securities within that portfolio. Diversification is going to be measured using the statistical metric called covariance or correlation coefficient. And I'm going to explain each of these. Let's say that there are 4 stocks at your disposal. Stocks A and B are high-risk stocks, and stocks C and D are low-risk stocks. Here you're thinking, you're saying, which of these 2 stocks should I invest in? You're considering investing in a portfolio of 2 securities. Now, let's consider this first factor that affects the risk of the portfolio. Let's say you decide on stocks A and B. Now, obviously, because these 2 stocks are high-risk stocks, all other factors, investment percentage and diversification held constant, you're going to wind up with a very high-risk portfolio. So surely, if you tilt your investments toward securities with very high risk, your overall portfolio risk exposure would also be very high. If, on the other hand, you settle on these 2 securities out here, C and D, now because these 2 securities are low-risk investments, surely, other factors held constant, your overall portfolio risk exposure would also be low. So, secondly, let's now consider the impact of your investment percentage. Let's say you have decided to invest in stocks A and C, a high-risk stock and a low-risk stock. You have $100,000 to invest. You decide that 80% of that, which is $80,000, will go into A and the remaining $20,000 will go into C. Now, surely you would agree that because you have put in a lot more of your wealth into stock A, which is a high-risk investment, your overall portfolio risk would be quite high. If conversely you choose to invest most of your money in stock C and very little in stock A, then your overall portfolio risk exposure would be low, in keeping with the fact that much more of your investment is in low risk stock C. So as you can see, by making the choice to dedicate more of your funds into the low risk investments, your overall portfolio risk exposure would be low. The third point here is diversification, which a lot of people talk about. And a lot of people would liken it to not putting all your eggs in one basket. It's better to separate them so that if at least one basket falls and the eggs crack, you still have a couple to tide you over. But let's consider this a little bit more thoughtfully. Say you have $100,000 to invest. Now, there are three portfolio options at your disposal. You can choose portfolio A, which requires that you invest all of your 100 grand into Google, a high-tech stock. Or you can take this 100,000 and invest the amount in these four stocks here: Google, Microsoft, Apple, and Intel. This is a portfolio of four stocks. But you can also choose portfolio C, which also comprises four stocks: Google, Deutsche Bank, American Airlines, and Target. Now, as you can easily see here, if you put all your $100,000 into portfolio A, which is a portfolio of one single security, as you can see, really, there is no diversification. If something goes bad with Google, you're going to lose everything you got. Okay, so let's step it up and consider portfolio B, which is surely a portfolio, but as you can see, this portfolio is not well diversified. As I note here, these are all high-tech stocks. And as a result, it is very likely that the types of risks that are inherent in Google are also going to be largely the same with Microsoft, Apple, and Intel. So much though as you have chosen a portfolio which is an investment in two or more securities, you really are not well diversified, and therefore you're not going to hedge much of any risk. The reason being that these four securities here are highly correlated. So the higher the correlation coefficient, the less diversified a portfolio is. Now then, consider our portfolio C. We have Google, which is a high-tech stock; Deutsche Bank, which is a financial services stock; American Airlines, which is an airline stock; and Target, which is a retail stock. So as you can see, these firms are pretty different one from another. And it's logical to conclude that this is a well-diversified portfolio. These securities have very little in common. They have a low correlation, or you can say they have a low covariance. They covary very little. And as a result, it's quite likely that if something is ailing with Google, Deutsche Bank, American Airlines, and Target may still have a smile on their face. And all things considered, you're better off if in fact your intent is to diversify away what we call in investments unsystematic risk or non-systematic risk. Non-systematic risk are risks that are unique to firms, and therefore by investing in companies in dissimilar businesses, you're able to kind of smooth them all out. So because in portfolio C, these securities have a low correlation, or if you like, low covariance, they are well diversified, and as a result will accomplish your goal of risk minimization, which is the reason why we choose to invest in portfolios. It's not returns maximization. If it is returns maximization, then you want to seek out one or two investments with the highest possible returns. But by choosing to invest in a portfolio, you're choosing to diversify away non-systematic risk. The lower the correlation coefficient, as we are going to demonstrate, the greater the diversification potential of a portfolio. It rises, and therefore the lower would be your overall portfolio risk exposure. And this is in terms again of the non-systematic, or if you like, company-specific risks of the individual securities. So let's look at a quick example. Here we have two securities, a portfolio of two stocks, A and B, and we have identified their historical returns. And with that, we use the models we showed in part 1 to calculate the mean for stock A and the mean for stock B. And likewise, the standard deviation for A and the standard deviation for B. Now, to calculate covariance, I show the sample covariance formula here. All we're doing here is we're going to subtract the mean of each security from each of the possible returns, and for each row we multiply the two. So that in the first observation we're going to subtract the mean from the first observation of A, which as you see here is 0.5, and that's what you see right here. And then we multiply that by the corresponding difference for B. So for B, we're going to subtract the mean from 0.25, and that's what you see right here. The mean for B is 0.13. So subtract it from 0.25. So you multiply these two together and store in perhaps number 1. Do the same for the second row, store in number 2, third row, and fourth and final row as you see them right here. So when you multiply these out, these are the temporary results that you're going to get, and then you sum all of these. When you sum them all, you're going to get 0.025, and that's the numerator right here. You divide by 4 minus 1 degrees of freedom. Remember, we have 4 observations, sample size of 4. So 4 minus 1 is 3 divided into this. This is our final answer. What does this mean? Well, couple of things. One is, if this result had been 0, then we would have concluded that these two securities have nothing in common. If it's negative, which it can be negative, then it's telling us that these securities move in opposite directions. If one's going up, the other one is doing well. The other one may be doing poorly, and vice versa. Usually, when securities are negatively correlated, you can maximize the diversification potential of such a portfolio. The more it tends toward larger negative values, the better the portfolio is suited for someone who wishes to minimize portfolio risk. So the final thing is, if it's positive, then it tells us the two securities move together. However, the degree to which they move together we don't really know, because covariance can be any number from the negatives to the positives. So perhaps we need a more succinct measure of portfolio diversification, and that's going to be correlation coefficient, which as you see is bounded between -1 and 1. If R, correlation coefficient, is 0, then that's in the case where covariance, the numerator, is 0, meaning the two have nothing in common. If it's -1, then the two investments are perfectly positively correlated. And in such a case, there is an opportunity to maximize, maximize, as it were, the diversification potential of the portfolio. If it's +1, then there really is nothing to diversify away. The two securities move in tandem. So anything less than 1 would offer us an opportunity to reduce risk, as in this example, which it comes out to be 0.14. And as you can see here, correlation coefficient is simply the ratio of the covariance and the products of the standard deviation of the two securities. And that's what I've done here, which tells you that given the correlation coefficient and the standard deviation of the two securities, by multiplying through, you can also backtrack and get the covariance. So on Spreadsheet, right here, let me get rid of that. We can use the covariance function on Spreadsheet. Covariance, all right, .s will tell the computer that we wish to calculate the sample covariance. Open parenthesis. Get this array for stock A, and it tells you here to put comma. So I'm going to put comma, and then get this here for stock B. Do not include the labels, and then close parenthesis and enter, and that's your covariance for A and B. For correlation coefficient, it's Correl, C-O-R-R-E-L. That's it. Open parenthesis, get all the observations for stock A, comma, get all the observations for stock B, close parenthesis, enter. So it tells you that the correlation coefficient is approximately 0.14. Now, for fun though, I've added a stock C here. We could be considering the correlation, the covariance and or correlation for three asset portfolio A, B, and C. Now, to do so, we're going to have to calculate the covariance and correlations between pairs of these securities. We're going to do as A and B, A and C, B and C, and what is it? Yeah, that really. So it might be a little tedious. So why don't we use the covariance dialog box under data? You click on data right here, and then you click on data analysis. If you do not have data analysis, go on file or whichever Excel version you're using and look for options and then add in, so you can add it in. So here I'm going to click data analysis and I'm going to choose correlation. Let's do correlation and hit OK. And I'm going to cancel what I did before so you know precisely how this goes. Let's get rid of it. So click back over here. So while cursor's blinking there, I'm going to highlight all of these three columns, including, yes, their labels. When using this dialog box, you can go ahead and include the labels, which is good because then the computer is going to kind of carefully give you the results for each of these securities. And then next, click labels, so the computer knows the first row contains labels. And then click here, output range, and afterward, click here in the open window. So there are four things to click. First, identify the rows. Second, labels in first row. Third, click output range. And fourthly, click in this open window, which here now, while cursor is blinking in this open window, click right here, anywhere on the spreadsheet really, so the computer knows where to post the output, and click OK. Now there you have it. This is the correlation between A and B, which we already calculated here to be 1.36. This here is the correlation between, as you can see, A and C, which is a negative. It tells us that these two securities move in opposite directions. And for B and C, we have it right here. The correlation between B and C is approximately 0.7, or in this case 0.6897 exactly. So these two securities move in the same direction. Actually, they move more in the same direction than A and B, as you can see. Going back to the presentation, we can also calculate the covariance and correlation using probability data. For this, there is no spreadsheet function. So first, we calculate the means of each of the two securities and their variances and their standard deviations using the method described in part 1. And then here is the definition of the covariance of a probability distribution. We do not divide by n-1 degrees of freedom. Instead, when we multiply these two differences, we in turn multiply them by the corresponding probability. So as I show here, we subtract the mean for A from the first observation of negative 0.12, you see it right there, and we do the same correspondingly for B, subtracting its mean from 0.10. You can see it right here, right there. And then you take these two multiplied by the corresponding probability of 0.2, and you see that 0.2 right here. So when you multiply through, that's going to be your result right there. You do the same for the second row, that's your result. For the third and final row, that's your result. You add them all up, and that's your answer. So these two securities right here, A and B, using probability distribution, have a negative covariance. So they move in different directions. But the degree to which they move in different directions, we would have to verify using correlation coefficients, which comes out to be negative 0.6. So it's pretty close to negative 0.1 to negative 1, as you can see. So these two securities are they move quite a bit in very opposite directions. And again, remember that the more correlation coefficient tends toward -1, the greater is the diversification potential of such a portfolio.